Happy Wednesday, everybody. I am Nathan Larson from Squire Wealth Advisors. Thank you for taking some time to listen to our State of the Market address today. I'm pleased to introduce Kevin Grogan. He's the Chief Investment Officer of Systematic Strategies for Focus Partners. And what he likes most about his role is the opportunity to collaborate every day with advisors, clients, and prospects, helping others better understand the complicated concepts that will have a tangible effect on their financial lives. Kevin has co-authored 3 books. His most recent book, Your Complete Guide to a Successful and Secure Retirement, with Larry Swedroe, was named by the Wall Street Journal as the best retirement book of 2019. He's here to talk today about the state of the market and enlighten us on what's going on there. As far as housekeeping goes, if you have questions along the way, there is a Q&A section on the webinar that you can type your questions in, and I'll be monitoring those, and hopefully we can get some answers to our questions from Kevin. With that said, Kevin, go take it away. Happy you're here.
Yeah, good to be here, Nathan. And yeah, thanks to everybody for tuning in today. So I have a few, as you can, you'll be able to see here in a second, have a handful of slides to kind of go through to talk a little bit about the market. And I do think you kind of have a circumstance right now where things are somewhat contradictory in the sense that you have some headlines that are pretty negative and have been pretty negative over the course of the year. Meanwhile, the markets have performed really well so far this year, and I'll talk more about that coming up here in a second. But there's certainly no shortage of topics to discuss. We've got a new chair at the Federal Reserve. We've got inflation that is still kind of stubbornly above the Fed's long-run target. You've got geopolitics and energy issues in the headlines. And then, of course, lots of headlines also about artificial intelligence as well. So as was mentioned, we do have a good bit of time for questions, so feel free to send those in along the way or wait for the end. Either way works, and we'll kind of address them as we go. So in terms of the topics that I plan to cover here today, so first, talk just kind of about what has happened so far this year, both from a markets perspective as well as an economic perspective. Next, I'll talk through the new Fed chair, and honestly, most importantly, what it means for you and for your portfolio. Third, I'll talk about just kind of an update, a refresher on where things stand in fixed income world or in bonds right now, because I do think that is kind of an under the radar good news story for most retirees. And then finally, just kind of walk through the last few months and how they are kind of a case study on why it's so important to stay disciplined, even as the headlines start to get loud and stressful. And so, again, kind of underlying that importance of staying disciplined to your long-term plan. And again, as I mentioned, we will have a good bit of time for Q&A at the end as well. So jumping into how markets performed in the second quarter, you can kind of see here on the slide, moving from left to right, you have different areas of the stock market, then bonds, and then kind of a category where we just threw everything else into called non-traditional. And so a few things kind of stand out on the slide. So starting within U.S. stocks, we saw small caps do a bit better than large caps for the quarter, but although both did really well, so large caps up 15%, small caps up 16%. As you compare growth versus value, it was a quarter where growth did a good bit better than value. So growth stocks up almost 22%, value stocks up 8%. And then the last comparison that I like to look at is U.S. stocks versus international stocks. So again, U.S. large caps up 15, did better than international stocks, up about 10. Although emerging markets were the best performing area of the stock market in the second quarter, up about 23 or 22.5% or so for the quarter. Moving over to fixed income, a pretty quiet quarter on the bond side. We did see rates move up a little bit over the course of the quarter, which does reduce the price of bonds, but the income level or the yield on bonds was enough to kind of offset that reduction in price, and you still got kind of a modestly positive return from bonds in the second quarter. And then on the non-traditional side, the main thing I would highlight here is that real estate did really well in the quarter. and commodities did particularly poorly. I would note, though, that commodities return was coming off of a quarter where commodities did incredibly well back in the first quarter, as we saw commodities prices bid up due to the geopolitical issues in the Middle East and in Iran specifically. So commodities did give some of that back in the second quarter, but still, again, pretty good year overall, really for pretty much all of the asset classes that we track so far this year. And so that's kind of the big picture message for folks who aren't paying attention to markets day to day, is that things continue to go pretty well here in 2026. Moving over to the economic side, I've got a few different bullet points that I put on this slide. So first, economic growth has been resilient, but inflation has remained kind of stubbornly above the Fed's long-run 2% target. So the economy keeps expanding, although I would admit that the economy is expanding at a slower pace than what most forecasters were predicting back in January. And at the same time, inflation hasn't fallen as much as certainly the Fed had hoped this year, or as much as forecasters were predicting at the beginning of the year. Now, of course, on that inflation point, a good bit of that was due to, of course, tariffs are a factor there, but especially the geopolitical issues cause higher energy prices, and that has led to inflation remaining above target, and not said another way, not coming down as much as policymakers had hoped at the beginning of the year. And second, bullet point relates to the Federal Reserve. And so kind of, again, you kind of have had a shift over the course of the year. At the beginning of the year, markets were forecasting that the Fed would cut rates twice over the course of 2026. If you look at where the market is pricing in today, it's now pricing in the possibility of a hike of interest rates over the course of 2026. So just one, though. So, but again, that is a pretty meaningful difference in the sense that Fed funds target rates were expected to move from, say, 3.5% down to 3%. Maybe now they move to 3.75%. And so it is a meaningful change in just kind of the tone at the Federal Reserve. And I'll talk more about the Fed coming up on a later slide, but it just kind of helps illustrate how difficult it is to predict the future path of monetary policy. And then third, again, is another one that I'll dive into deeper a bit later on, but if interest rates will be higher for longer, there is a silver lining in the sense that for a diversified investor, if rates remain high, they aren't super volatile, and you continue to have modest but still positive growth in earnings, that's a really good environment for diversified investors, in the sense that it's not sort of this environment where everything is sort of taking off to the moon, but if you're getting kind of steady results out of both the stock and bond sides of your portfolio, that's a really good result for most investors, and in the sense that you don't need dramatically high supercharged growth in order to achieve your goals. If that's the circumstance that you're in, this has been a pretty good environment for that type of investor so far. And so I do think there is a good bit of, as I mentioned, kind of contradiction between what the headlines are and what has actually happened, both in the economic data and within actual equity market returns, in the sense that economic data, again, not as good as was forecast at the beginning of the year, but still looking pretty robust in terms of what the economy looks like. And of course, the market returns are what they are, still really positive over the course of 2026. And so really our advice, and again, this will be kind of a theme throughout the talk today, is just try to stay disciplined to your long-term plan, and as best you can, try to tune out that noise that might cause you to drift away or make alterations to your plan. And so just to kind of provide a little bit more detail on each of these. On the growth front, consumer spending has held up really well, despite sentiment really taking a decline. And so what that kind of means is that consumer sentiment is measured by surveys. So they send out surveys to consumers, and on the whole, consumers aren't feeling all that great about the economy. So in terms of how they respond to surveys, they're saying things like they're not optimistic over the next 6 to 12 months. They don't think job growth will be there. They think prices will keep rising, things like that. But on the other hand, consumers are still spending in a reasonably big way. So they're still taking trips, going out to dinner, having those experiences, and still spending money in a really robust way. So again, you kind of see that contradiction from what people are saying they will do versus what they are actually doing. And again, what really matters for markets is what they actually do, because the markets are pricing in kind of the present value of future earnings on different companies. And so as long as those companies are still generating earnings, that will be a positive for the stock market. On inflation, I mentioned this a second ago, but I think inflation not coming down quite as fast as policymakers would like is largely driven by the rise in energy prices and the rising geopolitical tensions. And I think that's important for two reasons. One, to the extent that some of the geopolitical issues get resolved, that would help, I think, calm down inflation, number one. And number two, if it really is just kind of concentrated in the energy sector, that is different from the inflation that we saw 4 or 5 years ago, where kind of everything was rising in price, not just energy prices. And so I think that is an important distinction in the sense that rises in energy prices or energy inflation can tend to be very volatile. And so just because it's running very hot right now does not necessarily mean it will be running hot 6 to 12 months from now. And so that's an important thing to remember. And then finally, on the Federal Reserve and rates point, I would just kind of underline again just how much expectations have changed over the past 6 months ago. Again, moving from expecting rate cuts to now expecting the possibility of a rate hike. And so next slide kind of talks more about kind of the change in leadership at the Federal Reserve. And I put a good bit of text on this slide so you can kind of read through it. But essentially, the Federal Reserve now has a new chair, and it's expected that Kevin Warsh, who is the new chair, will be kind of the biggest change in tone and biggest change in leadership at the Federal Reserve in some time, likely the biggest shift that we've seen probably in 10 to 20 years or so. And so whenever that happens, it's kind of natural to wonder, what does this mean for me? What does this mean for my portfolio? And that's really what this slide attempts to address. So in terms of what's changed, Kevin Warsh has, both in recent years and really over time, has been more hawkish, meaning that he's more focused on the inflation side of the Fed's mandate than he is on the employment side of the Fed's mandate. He's also said he's not a fan of what's called forward guidance, or this idea that the Fed would kind of telegraph or communicate what is its expected path of interest rates. He is not a fan of that aspect of the Federal Reserve. And so kind of taking all of this together, as I mentioned earlier, markets have shifted from pricing cuts into pricing hikes, and that is a pretty big change in expectations. Now, with all of that said, there's still a good bit that hasn't changed as a result in the change in leadership. So number one, so the Fed still has the same two mandates that it's always had, which is for full employment and stable prices. So it will still be responsive to incoming inflation data and incoming data on the job market. Second, policy still moves by committee. So it's not as if a new chair can just make wholesale changes, specifically when it comes to changes in the Fed's short-term interest rate, which it controls. That is still voted on by committee, and Kevin Warsh is one vote, but one of 12. So he's not kind of a deciding factor. So that is still, I think, an important aspect of governance related to the Fed. And then finally, as I mentioned earlier, predicting short-term interest rate moves is still very, very difficult. And again, we think it's best to stay disciplined to your long-term plan as opposed to trying to guess what the Fed might do next. And so in terms of what it means for you, and this is somewhat anticlimactic because, again, it's kind of the theme of the presentation, but your plan is built to work across a range of different interest rate environments. And we don't recommend, again, making changes to the portfolio based on what the Federal Reserve might do or might not do. And so one question that often comes up here is, well, if the market has priced in the possibility of 2 rate hikes later this year, can't we do something to get in front of that, to position our portfolios to take advantage of that? But it's important to remember that the possibility of a Fed rate hike is already baked into today's prices, not just in the bond market, but also in the stock market. So if you wanted to do something active with your portfolio in response to a forecast of short-term interest rates, you need to do something that's against consensus or is against what the rest of the market is already expecting. And so, again, we don't really think there's anyone that has the ability to do that consistently and try to just, I think it's the best approach to kind of accept the market's estimate, kind of the collective wisdom of market participants as the kind of the best guess as to what might happen next. Of course, it won't be right all the time. I mentioned how those odds have shifted over the course of 2026, but over time, we think that's a better approach than trying to outguess what the market might do. And so, bottom line is, I don't think you need to lose any sleep over the change in leadership at the Fed. We will continue to pay attention to what's happening with the Federal Reserve so that you don't have to. But bottom line is, again, don't really recommend much in the way of changes to the portfolio based on the new leadership at the Federal Reserve. So next topic is kind of a revisiting of fixed income. And I do think this is kind of a good news story that has flown a bit under the radar. So as you think back to 2022, which was a really challenging year in bond markets, but really kind of in markets as a whole, that was a pretty painful year to own bonds because we did see interest rates move up a lot over the course of just 1 year. And because, as I mentioned earlier, bond prices move in opposite direction relative to rates, that means that as interest rates were rising that year, the prices of those bonds declined in value over the course of 2022. And what made it doubly challenging is it was also a negative year for the stock market. So you had both stocks down and bonds down in the same year in 2022. And so that was, again, very challenging year, but kind of on the back end of it, you can kind of see where we are now by looking at the chart that I have up on the screen now. You can kind of see where the starting yield was on a 10-year treasury at the beginning of each of these years and then ending in middle of 2026. And so if you go back to 2021, the yield on a 10-year treasury bond was less than 1%, meaning you could tie up your money for 10 years in a high credit quality bond and earn less than 1%. And that's where we were back at the beginning of 2021. And you fast forward to today, and that number is now closer to, say, 4.5%. And so we think the starting yield is kind of the best estimate of a forward-looking expected return on bonds. And so that has a couple big advantages for investors, and particularly for retirees, to have interest rates and expected returns be so much higher than what they were just about 5 years ago. So back in 2021, and really honestly for most of the 2010s as well, bonds weren't really paying much of anything. And so if you wanted to have a portion of your portfolio that was safe, you had to accept returns that were very, very low. Again, kind of 1% or lower for much of that sort of decade plus coming out of the financial crisis. And so that's no longer the case, in the sense that you can have a robust allocation to safe investments that have a respectable yield that you can actually live off of. 4 to 5% is a really nice return that you can get on the safe portion of your portfolio. The second factor of having interest rates be higher is that it does make fixed income an even better diversifier for stock market risk, essentially, in the sense that as the stock market goes under stress and declines in value, you now have a portion of the portfolio that's not only holding its ground, but is delivering a nice return along with it. And I also think it somewhat helps psychologically, in the sense that if you have stocks that are pulling back, it can help you stick with those stocks, knowing that you have a portion of your portfolio that is earning a real return, but is also safe. And so really the takeaway here is that the safe portion of your portfolio is healthier now than it was for all of the 2010s up through, call it 2021 and 2022. And so that does make a meaningful difference as we do planning for clients in terms of when can they retire, how much can they spend in retirement. Having the safe portion with a reasonable expected return is really, really helpful. Now, the one caveat I would say is that yields being higher does not make fixed income completely risk-free. If we did see runaway inflation and interest rates moving much higher than they are today, that, similar to back in 2022, would mean that the prices of those bonds would fall. I'd say the big difference, though, is that you now have a starting yield that's higher. So if you had interest rates, so let's say you're like our typical bond portfolios have what's known as a duration of around, call it 3 to 4 years, meaning if interest rates move up by 1%, you would expect the value of the bonds to decline by, say, 3 to 4%. Well, if your starting yield is, call it 4.5%, having the value decline by 3 to 4% still leaves you in positive territory. And so that's kind of that point I was getting to, that the bond portion of the portfolio is healthier now than it has been. Certainly healthier than it was for much of the 2010s into the early 2020s. And so next, kind of want to talk through a case study of this year, where it's kind of easy to forget how volatile and how stressful markets were as the geopolitical conflict started back at the end of the first quarter. But that's just kind of one example of a headline that can cause stress. Of course, it's a different thing. It feels like every year. This year, it's oil prices spiking due to Middle East conflict. Last year, it was newly announced tariffs. So it can come from a different place every year, but no matter what, pretty much every year you're going to see some headline that's going to cause some stress in the markets. And you might see stock markets pull back, and due to kind of the loud, scary headline that you might see. And oftentimes the natural reflex is to not just stand there, but do something, kind of sell into the volatility, pull money out of stocks to wait for things to come back down and try to get back in. But unfortunately, the evidence on that is not great, in the sense that your much better approach is to stay invested in your long-term portfolio, as opposed to trying to sell as headlines get loud, try to wait for things to calm down. And part of the reason is that many of the best days of stock market returns tend to be during the periods where stocks are very volatile and things look pretty scary. And so kind of the most recent example of that you can think of was back in March of 2020. Things looked extremely scary. Markets pulled back 40-50% over a period of 6 to 8 weeks. That was a very, very quick drawdown. And if you were an investor who sold coming out of that, there was never really a signal to get back in. Maybe you would say that the signal to get back in was when we started to get good news on the vaccine trials that came out later that year. But even then, by the time that news came out, the market had more than rebounded and had already advanced a significant degree in 2020. And so the best approach is kind of under that number 4, is just staying disciplined to your diversified portfolio. Really is kind of the best edge you can have, and take advantage of those positive days that are clustered during those periods of volatility and during those periods of market stress. And so one of the reasons why stocks have historically earned such a high return over what you can earn on safe cash or safe fixed income is that it can be difficult to live with that stock market volatility, that you need to live through the periods where the stock market pulls back and hold on, even as things look very loud or stressful in the markets and sometimes in the world as a whole. And so we don't believe that there's any evidence that anyone has the ability to consistently predict when to get in or out of the market. Again, the evidence on timing the market is pretty rough, in the sense that there's been no one really who's been shown to be able to do that consistently. So our best advice is to stay disciplined to your long run plan, as opposed to trying to time the market and guess what might happen next. So 3 things worth remembering here. Number 1 is that uncertainty is a constant. So I mentioned that we had the oil price volatility and the geopolitical conflict this year. Last year, it was the tariffs. A couple of years before that, it was inflation running rampant. And a couple of years before that, it was COVID. And so there's always something that can cause uncertainty in the markets. It's just a matter of what the new headline is that is causing stress. But over the long run, we think that stocks should do better than safe cash and safe fixed income. And really the key is staying disciplined to that strategy. Another thing I mentioned on that first bullet point is that the market reaching all-time highs is normal. If you have something that has a positive expected return, it has to reach all-time highs to continue to deliver that positive return. So just the fact that the market is an all-time high is not a signal to get out of the market or change your plan or anything like that. A second bullet point there, a new Fed chair is not a reason to change the plan. Again, the Fed operates by committee, and even if there are changes to Federal Reserve policy, they're likely already really well reflected in kind of the way the markets are pricing securities today. So that's an important thing to remember as well. And then three is that diversification is doing its job, probably better now than it has in some time, in the sense that bonds have respectable expected returns again. And really kind of the best approach for your long run plan is just staying disciplined to that long run strategy over time. So that was all I had in terms of prepared content, but yeah, happy to take any questions that you all have.
Thank you, Kevin. That was great. One thing I was just thinking about with the consumer sentiment versus the actual spending, what's going on there. Have you seen any data or numbers on the World Cup's impact? Did that help the sentiment and the economy there, or?
So yeah, I have not, in terms of specifically on the World Cup, how that was changing consumer sentiment. There have been a good bit of studies out recently that consumer sentiment surveys might just be broken, either for now or forever, in the sense that what they found is that consumer sentiments surveys have become very partisan. So if you are more Republican inclined, you're more likely to say that things are going great right now. If you are more liberal/Democrat inclined, you're inclined to say things are going terrible right now, without really any relationship to how things are actually going in your life. And then as administrations change, people then flip. And so there is some questions or skepticism now that just kind of our country/society has become so partisan that maybe these sentiment surveys aren't really adding any informative value anymore. And so that's one possibility that could explain kind of this divergence between people spending a lot of money, but saying that they think there's a decent possibility that lots of people will lose their job coming up forward. The other thing that you see too in the survey data that's been happening now for 5 or 6 years is that people in general have become pretty optimistic about their own circumstance, where they'll say, I think the prospects for my job, my compensation are great over the next 12 to 24 months. But I think the prospect for my neighbors or the country as a whole is really negative over the next 12 to 24 months. Now, of course, like that can't be true for everyone, because it's sort of like not everyone can be an above average driver. But that is what you do start to see in the consumer sentiment data, though.
It's super fascinating. So for all the attendees, remember, if you have questions for Kevin, type those in the Q&A section of the chat and we'll try to get those answered. Kevin, one other question I was thinking about, with inflation being sticky, higher inflation being sticky, and seems like an inability to get it down to the target over the past 3 years or so. What impact does that? I know that means higher interest rates, and that's one of the reasons why we've had a little bit of a higher interest rate. What about the federal debt and that interest rate? I know there's a correlation there, and we do have kind of the headlines in the news about Social Security's trust fund running out in 2032, and the interest with a large portion of the GDP going to interest debt servicing. We're kind of in a sticky spot with that interest rate and the federal debt, right?
We are. So So even setting aside the interest rate, which is a major factor too, it is a major issue. So like a lot of the studies that are out there look to see when does, say, debt to GDP become a problem for a country. And it starts becoming a problem north of 100% debt to GDP, which is where we already are. North of 120%, that's when you start to run into real issues in terms of just government spending kind of crowding out private investment, not having governments not having the ability to be what's called counter-cyclical, in the sense that you think back to COVID, when the economy was kind of necessarily pulling back due to restaurants closing and everything else closing, and the government sent out a bunch of money to try to be what's called counter-cyclical, support the economy as the economy was pulling back. As you start to have really high debt to GDP, the government doesn't have that same ability. And so you're just sort of stuck with sort of the economic consequences of whatever is happening at a given moment. So yes, it is a real issue, and it does kind of feed on itself, because the higher your debt to GDP ratio is, the higher the interest rate investors will charge, because they become more and more skeptical that you're going to pay back the debt. So it does become kind of a spiral upon itself. So there are real issues here, and I think as a country, I think it is pretty challenging one for us to get out of, just at least in terms of how things are set up today with the political party. So you go back 50 years, and again, this is stereotyping, probably painting with too broad a brush, but in general, Republican candidates would be the party of cutting taxes and cutting spending. Democrat candidates would generally be the party of raising spending, but also raising taxes. Where we kind of are now is, it feels like Republicans are the party of cutting taxes, but they don't cut spending. Democrats do, but they both really increase spending at this point, and Democrats don't even really raise taxes either. If you look at a lot of the different proposals that are out there, they're often focused on, well, can we tax kind of the 0.1% more, or the top 1% more? You can do that, but that just does not get you very far. You need to kind of have a broader tax base to really deal with the issues that we have on the fiscal side. So kind of bottom line is that it's likely going to need to be, at some point, a combination of both, getting real about the spending, but also kind of broadening out the tax base beyond just the top 0.1 or the top 1 to 2% of the income distribution, most likely. So I would say, on the specific point about Social Security, there are a lot of headlines about that. I tend not to worry about that too much, in the sense that the voters who receive Social Security tend to vote in pretty big numbers. So I wouldn't anticipate major changes to that, except maybe to maybe younger individuals, kind of in the form of either raising, some combination of raising retirement ages, means testing Social Security a bit more, maybe lifting the cap on payroll tax. Those would all be kind of solutions that could help with that. So yeah, we'll be interesting to see how that plays out. I don't really worry much about kind of the Social Security defaulting or things like that, but there could be changes, to particularly for people who aren't yet receiving benefits.
Yeah, thank you for answering that. Doesn't look like we have any other questions. One other thing, last thing I'll just mention that I've been thinking about with the dollar, the US dollar seems to be making a little bit of a comeback. Does that have an impact potentially on the international stock returns? I know last year we had really good international stock returns, and some of that might have been related to the dollar declining.
It was. So yeah, the international stock portion of our portfolios are left completely unhedged with respect to the dollar, meaning that if the dollar does well, that causes negative performance on the international stocks, and vice versa. And so we think that's a good thing in the portfolio. Of course, most of our clients' portfolio is denominated in US dollars. The entire US equity component, and for the most part, the entire fixed income component, all denominated in US dollars, which makes sense. Most of our clients' spending happens in US dollars, but we think having a portion of the portfolio allocated outside of the US and exposed to non-dollar denominated currencies is a positive, because it does provide diversification. So if you do see the dollar decline in value, that would be a tailwind to the international stock portion of the portfolio.
Yeah. Okay, great. Well, thank you so much, Kevin. It's always a pleasure to have you speak to us, and we love your insight. Hope you have a great day. If you have questions reach out to your advisor. Happy to help answer specific questions to your situations, and everybody have a great day.
Thank you.